For 20 years, the most successful investment firm in history did not actually execute a single trade. Bernie Madoff was not just a trader, he was the architecture of the modern market. He was the man the regulators called for advice, the chairman of the NASDAQ, and the gold standard of Wall Street trust. To have your money with Madoff wasn't just a financial decision, it was a status symbol. It was the ultimate in for the global elite. But behind the mahogany doors and the sterile, high-end prestige of the Lipstick Building in Manhattan, there was no market activity. There were no dividends. There was only a $65 billion void, meticulously managed by a man who realized that the world is too polite to double-check a legend. This is not a story of a market crash or a bad streak of luck. This is the forensic breakdown of a financial homicide, a 2-decade-long deception that turned the global elite into the victims of a common thief. This is the autopsy of the $65 billion ghost. To understand the scale of this deception, we must first look at the physical and psychological geography of the crime scene. Bernard L. Madoff Investment Securities operated out of the Lipstick Building on 3rd Avenue. The firm was split into two entirely different worlds. On the 18th and 19th floors, everything was legitimate. This was the market-making side of the business, a high-tech operation that helped pioneer the digital trading systems we use today. This side of the office was transparent, audited, and highly respected. It served as the perfect camouflage. But it was the 17th floor where the investment advisory business lived. This floor was a time capsule. While the rest of the world moved into the 21st century, the 17th floor was intentionally kept in the 1980s. It was filled with old IBM computers, dot matrix printers, and a small insular staff of people who often had no formal financial training. This was the engine room of the fraud. Here, Frank DePascali, Madoff's right-hand man, oversaw the generation of thousands of fake trade confirmations and account statements. The strategy was simple. The 17th floor would wait for the markets to close, look at the historical data of which stocks performed well that day, and then backdate trades to make it look like Madoff had bought low and sold high. They weren't predicting the future, they were rewriting the past. The product Madoff sold to the world was called the split strike conversion strategy. On paper, it was elegant. Madoff claimed to buy a basket of large-cap stocks that mirrored the S&P 100 index. To protect against a market crash, he would buy put options, essentially insurance policies that pay out if the stock price drops. To pay for those puts, he would sell call options, which limited his upside but guaranteed a steady, narrow band of profit. In the world of finance, this is a real strategy. It's designed for safety, not for massive growth. But Madoff's execution of it was a mathematical impossibility. When forensic analysts like Harry Markopolos began looking at Madoff's returns, they noticed something terrifying. The line representing Madoff's profits didn't look like a market chart, it looked like a flight of stairs, always moving upward at a 45-degree angle. In over 20 years, Madoff only reported a handful of losing months. Even when the dot-com bubble burst, even when the markets were reeling after 9/11, Madoff's returns remained unshakable. There is a concept in finance called the efficient market hypothesis. It suggests that it is impossible to beat the market consistently without taking on massive risk. Madoff was claiming to beat the market with zero risk. Mathematically, for Madoff to be doing what he claimed, he would have had to purchase more option contracts than actually existed on the Chicago Board Options Exchange. He was claiming to be a ghost in the machine, moving billions of dollars through the pipes of the global economy without leaving a single footprint in the actual markets. Why did the world's most sophisticated investors fall for it? The answer lies in the velvet rope effect. Madoff didn't chase investors, he made investors chase him. He cultivated an aura of extreme exclusivity. If you asked too many questions about how the strategy worked, he would simply tell you that you weren't the right fit for the firm and offer to return your money. This created a psychological paradox. The more secretive he was, the more people trusted him. He targeted specific communities, country clubs in Palm Beach, charitable foundations in New York, and elite feeder funds in Europe. These feeder funds, like Fairfield Greenwich and the Ascot Fund, acted as massive vacuums. They collected money from thousands of smaller investors and funneled it directly into Madoff's 17th floor. They didn't do due diligence because they were blinded by the management fees they were earning and the prestige of being in with Bernie. But the most critical failure wasn't the investors, it was the regulators. Between 1992 and 2008, the SEC investigated Madoff 8 different times. Each time they walked into the lipstick building, and each time they left satisfied. They were looking at Madoff's status as a former chairman of the NASDAQ and assuming that a man of his stature couldn't possibly be a common thief. They checked his registration forms, but they never performed a basic counterparty check. They never called a third-party bank to ask, does Bernie Madoff actually have these billions of dollars in stocks sitting in his account? The answer was always no, but no one ever asked the question. In a legitimate investment firm, client money is held in separate audited accounts. In Madoff's world, all the money went into one place, J.P. Morgan Chase 703. This was the central reservoir of the fraud. When a wealthy widow in Florida or a pension fund in Korea sent money to Madoff, it landed in account 703. It sat there until an earlier investor asked for a withdrawal. Madoff would then take the new money and send it to the old investor, labeling it as principal and profit. This is the definition of a Ponzi scheme. It is a biological organism that must constantly consume more than it excretes. As long as the amount of new money coming in was greater than the amount of money being withdrawn, the illusion remained intact. Madoff was essentially a high-stakes juggler, and for 20 years, he didn't drop a single ball. But the balls were getting heavier, and the air was getting thinner. The death of the Madoff scheme was not the result of a brilliant investigation. It was the collateral damage of a global catastrophe. In 2008, the subprime mortgage crisis triggered a liquidity crunch. The world's financial institutions realized they were holding trillions of dollars in toxic assets. Fear paralyzed the markets. Investors who had trusted Madoff for decades suddenly found themselves in a margin call in other parts of their lives. They needed cash immediately. In late 2008, the redemption requests started hitting the 17th floor like a tidal wave. Madoff needed $7 billion to pay back his clients. He looked at account 703. It was almost empty. The ghost profits he had typed onto statements for decades amounted to $65 billion, but the actual cash in the vault was less than a few hundred million. He tried to scramble. He reached out to his oldest friends and most loyal investors, asking for one last investment to help the firm through a temporary liquidity squeeze. He was trying to find one last victim to keep the machine running for a few more weeks. He failed. On December 10, 2008, the pressure reached the breaking point. Bernie Madoff sat in his penthouse and confessed to his family. He didn't describe it as a mistake or a series of bad trades. He described it as a big lie. He knew that the next day, the world would wake up to find that the gold standard of Wall Street was nothing more than a hollow shell. The aftermath of the Madoff collapse was a landscape of total destruction. The $65 billion figure that made headlines was the paper value, the total of all the fake profits Madoff had promised. The actual cash lost by investors was closer to $19 billion. But the numbers don't capture the human cost. There were investors who committed suicide when they realized they were penniless. There were charities like Elie Wiesel's Foundation for Humanity that saw their entire endowments vanish overnight. There were thousands of people who had done everything right, saving, investing with a safe firm, planning for retirement, only to find that their entire future was a fiction. The recovery effort, led by trustee Irving Picard, has been a masterclass in forensic accounting. By suing the big winners, the investors and feeder funds who withdrew more money than they put in, Picard has managed to recover over 70% of the lost principal. It is a feat of legal engineering that few thought possible in 2008. However, the financial autopsy of Bernie Madoff reveals a much darker conclusion. The crime was possible only because of a collective failure of skepticism. The feeder funds ignored the red flags because they were getting rich. The regulators ignored the whistleblowers because they were intimidated by prestige, and the investors ignored the math because they wanted to believe in a miracle. In the end, Bernie Madoff didn't invent a new way to steal. He simply exploited the oldest flaw in human nature, the desire to believe that somewhere, for someone, the rules of reality don't apply. The markets never forget, but they do forgive the next fraud. Subscribe to Financial Autopsy to see who falls next.